And 72% of the time the market goes up. And the answer came to me. And that's when I developed my chart. The answer came to me is because, just like Caterpillar, when they pull their money out, you get out.
Whoa. It's your daily dose of how to manage your money. And now it's time for Phil's Gang on the Off the Wall Street Network.
Oh, God. Are you nuts?
With your host, Phil Grande.
Bye. And welcome to my podcast, Monday. A lot to talk about today. It's interesting how people don't really understand how the market works. That's why so many people lose money, 73 to 93%. Today's a perfect example of what's going on. If you remember last Monday, we had a rally because Trump came on and said, well, we're negotiating well with Iran. We're holding off on bombing them. Looks good. So what happened? Everybody started to buy on a dip. I said, don't buy on a dip. You're going to give it all back. And they did. Now, today, Brent crude is above $115. WTI is above $101. That's keeping inflation fears alive for a lot of people. Now, remember, every recession since 1970, every time we had a spike in oil like this, it would follow with a recession. All except for COVID, of course. Now, most are worried not about inflation, but stagflation. Stagflation is horrible. It's hard to get out of once you get in. But here's what's going on. So last Monday we had a relief rally because of what Trump said. And then Friday we had a terrible day. And now there's another relief rally because yields hit a high of 4.42, then backed off 4.32, and then went up a little bit again, 4.34. So people saw those yields bouncing back. They decided to buy on the dip. What they don't understand is who's buying these bonds. It's the institutions. They drive the stock market. You don't have them buying stocks, your market's not going to go up. And that's the problem. When yields are dropping, as I say, someone's buying these 10-year treasuries. The institutions who also have been purchasing, remember, investment-grade bonds. Why? Because they give great safety. That's what they're looking for, is safety. So today they started to buy bonds. Now that's a far cry from buying stocks. So the dippers saw, oh, bond yield's going down. I'm going to buy on a dip. That's what they're doing. Well, you're nuts. That's insane. Now, remember, the credit spreads, that's the difference between what the 10-year Treasury yield is minus the investment-grade bond. Is around 88, and it has to be anywhere between 0 and 100. And that's when they're between 0 and 100, the institution's very comfortable. They find safety in there, and that's where they park their money. And they're parking their money there, not stocks. And that's really important to understand because right now, if you take investment-grade bonds between 0 and 100 basis points of safety, they're at 88. They're feeling very comfortable. So why would they buy stocks? So what did they do today? They went in and started to buy bonds for more safety. But the dippers didn't understand that. The dippers see the bond yields coming down, they start buying everything on dip. Well, they nuts, they're going to get killed. Now, the 10-year yield curve, take the yield curve. Now, you got to get that yield curve from 0 up to 150. And when it hits 150, what do institutions do? Fuel the market. They start buying stocks like crazy. We're not there. we're at 70. Oh, sorry, we were at 70, but today it dropped back to the low 50s. So instead of the yield curve going from 0 and curving up to 150 where they'll start buying stocks and dump their treasuries and dump all their bonds, what happened today is we saw the yield slide backwards to the 50s. So why are people buying on a dip? We're getting further and further away from institutions buying stocks. They're the only ones that can move the market. Not jibber jabbers on TV, not with fundamentals and storytelling. So now we're seeing it slip back to the 50s. And so what are they doing? Well, they're buying the investment grade bonds for safety. Now they're buying treasuries for safety. They're all about safety. And why? Because they see what's coming. Now, and what is that? Well, inflation or stagflation. Stagflation is the worst. And we're getting closer and closer to stagflation than inflation. Inflation, prices go up, but the economy's still growing. We're seeing the opposite. Stagflation is very easy to identify because the key signal of stagflation is when you see yields keep rising and for the wrong reasons. When yields are rising, that for the wrong reasons, like for example, all this inflation, the bondholders are saying, hell man, I want higher yields. So that's why yields are going up for the wrong reasons. So everything I'm trying to explain to you, we got a bunch of people out there buying on dips again. When the only people that move the stock market are institutions, but they got to buy stocks. And they're getting further and further and further away from stocks. Oil spiking, think about this. Oil spiking, and so inflation's going up, and foreigners just stopped buying bonds. They're not buying bonds to help bring them down. Why would they buy bonds? The exchange rate's too crazy. I mean, the exchange rate now is nuts. Who's going to take their euros and exchange them for dollars when dollars are going through the roof? So, we got oil spiking. The Europeans aren't helping by buying bonds. That's terrible because they control 30% of the bond market. And again, we also have to remember that besides the consumers, I mean, the consequences we're seeing right now, besides the consumers getting squeezed, companies are getting hit hard. Their earnings getting squeezed. Now, here's the real stupid thing. Who caused all this? Who caused all this? The Federal Reserve. They're trapped. They've been lying forever about the economy. They've been saying how strong the economy is. And they've been buying and buying and buying and buying and printing money and make sure the banks are buying treasuries to get those yields down so the stock market keep going up, making new highs every day. But it's caught up to them now. The Fed's trapped. Now, when I say the Fed's trapped, they can't raise rates to fight inflation. They can't lower rates to grow the economy. They got trapped out of stupidity, out of greed, out of making that new high every day, every day, every day. Go all the way back, QE1, QE2, QE3, 4, all that. So now, out of stupidity, because they printed too much money, all they kept doing is printing money to keep buying bonds, to keep dropping the yields down, so to keep driving the stock market up. But now they're dead. They can't keep this market rallying. That's why we've seen this terrible movement of the stock market going down. Now, thank God Trump is in there every day with his plunger team and making sure that the big dealers, the 5 biggest banks, are buying stocks, And then they force the arbitrage people to go in and put their computers on and do a lot of purchasing of stocks. And that's why you're not seeing 1,000-point days or 1,200-point days. We only had a couple. That's how they're stopping it. So behind the scenes, what's preventing this big crash in the market is Trump with his plunger team. Now, remember this. We have some severe consequences. Rates can't go up. They can't go down. The economy's too weak to raise rates to fight inflation. And the Fed, as I said, got trapped. So they printed too much money. They kept rates too low for too long. That's all they did. Are you nuts? And both stocks and bonds are now going to struggle. Stagflation is on the surface. No one wants to talk about it. And when you have stagflation, and it's going to hit us hard, and you can't get out of stagflation, you trade what benefits from high prices, like energy, commodities, sometimes commodities, but energy's been going straight up. We've been in XLE and XOP and other oils for, God, such a long time now. And then we've been, I think we've been in them since going back to January, if I'm right. And of course, we've been shorting everything else. So what's happening is right now, stagflation is on the horizon. And again, the small caps and the banks, the retail, they're just going to get crushed. And we have seen now a message from the market, the bond market, where you first get your signals of a correction or crash, where the bond market sets out the signal and IWM's been confirming it, but everybody's ignoring it. They're all ignoring it. Like today, buying on the dip. They're going to give all that money back, just like last Monday. So with inflation, people still can afford things because they have a job. And growth's okay, but with stagflation, it's brutal. Because stagflation, everything gets worse. Prices rise. Paychecks don't keep up. Spending drops. Companies' earnings get crushed. Households make less money. Bottom line, the stock market just struggles. And finally, you get a huge crash. The inflation is when prices keep going up while the economy slows. And that's what we have right now, but no one's talking about it. It happens when oil jumps. We have that. So the consequences right now are really severe. We just have to, again, when you see the bond market, when you see the institutions buying 10-year treasuries, and they're also buying investment-grade bonds, then why is anybody buying on the dip? Why aren't you shorting? You got to learn how to short. But people don't. All they do is listen to the jibber-jabbers on TV where they tell us every day everything's wonderful, everything's great. And it's not the case. So that's where we are right now. Oil, remember, institutions are not going to stop this collapse by going in and buying unless, one, oil has to stabilize. You got to stabilize oil. Two, the yield curve must keep steepening from 0 to 70 where we were to 150. Guess what? It's reversing now. That's dangerous. It's dangerous. We went from 70 backwards to the low 50s. The 10-year Treasury must stabilize between 4 and 4.25. We're not even close to 4.25. The Fed overnight rate has to go from 3.75 down to 2. We're never going to get to 2. No one's talking about this stuff. All I know is we've been short almost everything except for oil. And that's what's saving us. And right now, understand this. The 10-year yield has to be no higher than 4% to 4.25. Right now, the 10-year yield, if I'm correct, is at around 4.38. Too high. Too high. Credit spreads must be at 150 or better for banks to lend. They're not lending. And M2 money supply must increase, and it's not increasing. So there's no good news. But it's wonderful news if you know how to sell short. And I hope you work on shorting. It will help you with it. But everybody's just ignoring it. They're buying like everything's okay. It's not okay. We'll help you. See you in the charts.